All right, welcome back to The Explainer. Today, we're diving straight into a really fascinating analysis of the Industrial and Commercial Bank of China, or ICBC. We are literally talking about the world's absolute largest bank by total assets. Now, whether you track the Asian financial sector every single day, or you just want to get a better read on the shifting macro tides of global finance, this is an incredible story. We're watching a true behemoth pivot in real time. Here's our roadmap for today. We've got 5 key areas to cover. First, a giant's turning point, then the core financials, followed by the strategic pivot, valuation and yield, and finally, risks and verdict. Let's kick things off with Section 1, a giant's turning point, navigating the Chinese banking squeeze. 55 trillion yuan. I mean, just pause and think about that scale for a second. That is literally larger than the GDP of Germany and Japan combined. That's the sheer awe-inspiring size of ICBC's balance sheet. When an institution of this magnitude makes a move, it sends massive ripples across the entire global financial system. But lately, being a giant hasn't exactly been a walk in the park. For the last 2 years, this banking giant has faced some pretty brutal macro headwinds. Chinese banks have been squeezed incredibly hard by Beijing's aggressive push to lower lending rates. The goal there, of course, was to stimulate the post-pandemic economy. But the result? Severe margin compression across the entire banking sector. But here's exactly why we're digging into this today. Q1 2026, the results that just came out a few weeks ago signaled a quiet but absolutely massive inflection point. It's a shift that big institutional players are watching very, very closely because it suggests the bottom might finally be in. Moving on to Section 2, the core financials, looking beyond the headline profit. Okay, before we geek out on the exact numbers, we really need to understand the most critical metric for any commercial bank's profitability, and that's net interest margin, or NIM. Simply put, it's the difference between the interest income a bank generates from the loans it gives out and the interest it pays out to its depositors. It's basically the core engine of a bank's earnings. And like we just touched on, this NIM compression has basically been the ultimate villain for Chinese banks over the last couple of years. Because look, shrinking margins means shrinking core profitability. And it doesn't matter how huge your balance sheet is if your margins are collapsing. But then we get to this crucial little detail, plus 2 basis points. In Q1 2026, ICBC's net interest margin actually rebounded by 2 basis points quarter over quarter. Now, I know it sounds incredibly small, right? Like practically a rounding error. But in the commercial banking world, this is a dramatic reversal. It tells us their funding costs are finally stabilizing as they actively shift away from expensive time deposits over to cheaper current accounts. Essentially, the worst of the profit squeeze might actually be in the rearview mirror. And when we zoom out, the wider financial fundamentals are honestly super impressive. Operating income is up over 8%, net profit hit nearly 87 billion yuan. But the real masterclass here, it's their risk management. Their non-performing loans are holding steady at just 1.31%. Maintaining that kind of asset quality on a 55 trillion yuan balance sheet is wild. Plus, their operating cash flows surged 50% to 1.42 trillion yuan. So they aren't just surviving this squeeze, they've built up a massive war chest and they are ready to deploy it. All right, Section 3, the strategic pivot, the cross-border RMB initiative. This is where ICBC is really pulling ahead of the pack. They're basically rewriting their entire playbook. The old model was super reliant on domestic mortgages and infrastructure lending, but the new model, they are aggressively pivoting toward global trade settlement, transaction banking, and advisory services. They're adapting right alongside these global de-dollarization trends to create entirely new, higher-margin revenue streams on the world stage. And they are putting serious money where their mouth is. Back in April 2026, ICBC launched this landmark cross-border RMB financial solution, and they backed it with a staggering 1 trillion yuan special financing quota. That is a massive structural commitment. They are positioning themselves to be the primary clearing and settlement bridge for a whole new era of global trade using the renminbi. And you can see this strategy actively playing out in their lending book right now. Manufacturing loans are sitting at over 5 trillion yuan, and technology-focused loans are well over 6 trillion yuan. ICBC is perfectly syncing up with Beijing's industrial policy to fund high-tech manufacturing. They're really cementing their role as the indispensable financial bridge of the Chinese economy, both at home and globally. Let's roll into Section 4, Valuation and Yield, the smart money safe haven.
Real quick, to understand the valuation here, let's just define the price to book, or PB ratio. It just compares a company's market cap to its actual book value. Generally speaking, if you see a number under 1, it suggests the market has some skepticism, or maybe thinks the assets are slightly overvalued on paper.
So right now, ICBC's Hong Kong-listed H shares are trading at a PB ratio of roughly 0.59. Basically, you're buying $1's worth of assets for 59 cents. And yeah, sure, the market still harbors some skepticism about the broader economy, but a ratio this incredibly low, that also reveals massive upside potential, especially if the bank's profitability keeps rebounding exactly like we saw in Q1. And while you wait for that potential upside to kick in, let's talk about the yield. ICBC is offering a trailing dividend yield of roughly 4.74%. Just think about the global context right now. Bond yields are fluctuating all over the place. Uncertainty is literally everywhere. So finding a nearly 5% yield that is essentially backed by the Chinese state, that is a huge draw for anyone managing an income-focused portfolio. So how is institutional capital reacting to all this? Well, the analyst consensus paints a pretty clear picture. Citi says buy. JP Morgan is overweight. And DBS actually raised their target, calling it a solid dividend play. Even Goldman Sachs, sitting at neutral, acknowledges the bank's incredible stability. And the price action definitely reflects all of this optimism. H shares have gained over 10% year to date. Smart money is actively rotating in right now for that rare mix of yield and safety.
Finally, Section 5, Risks and Verdict. The catch and the conclusion.
Okay, so what is the catch, right? Every investment has risks, and we have to keep a balanced view here. First, the macro low-interest environment. If the People's Bank of China suddenly pushes through aggressive rate cuts, that could instantly reverse the NIM stability we just celebrated. Second, the real estate sector. The residual fallout from China's property market is still causing some long-term asset quality jitters, which totally explains that low price-to-book ratio. And third, stringent capital levels and strict provisioning requirements could always cap how high the share price can actually run. But taking all of that into account, the overall thesis from our source material really boils down to this one direct quote. We view ICBC as a high-quality, defensive core holding for income-focused portfolios.
Because that stabilized net interest margin removes the biggest near-term threat to their earnings. Plus, this strategic push into cross-border RMB services, it gives them a very real, tangible growth narrative that we honestly haven't seen from this bank in years. So the explicit verdict derived from this analysis is overweight, with a fair value target trending toward the 7.7 to 7.9 Hong Kong dollar range over the next 12 months.
Which leaves us with one really fascinating big picture thought to chew on as we wrap up. As global trade increasingly de-dollarizes, is ICBC quietly positioning itself to become the indispensable bank of a brand new global order? It's a huge question, and it's exactly why keeping an eye on this institution is an absolute must right now. Thanks so much for joining me for today's Explainer. I hope you found these insights as compelling as I did, and I'll catch you on the next one.